Hey everybody, Chuck Barone. Friday, March the 10th, 2023. Let's wrap up this crazy week. Big doings today. We kind of figured that yesterday and today would be the wrap of this week, and sure enough, we're not going to be disappointed, are we guys? But before we start the show, as always, we want to welcome you to the show. Thank you guys always for your support. We appreciate it. You guys watching these videos keeps us going. Keep on going, guys. We appreciate you. Markets today. Well, we had a lot of information come our way today. We had a bank failure, a shocker. Well, not a shocker, but that kind of stuff always shocks the market. So as a result of all the fun we had today, news in the markets, stock market today, kablah. Dow down 345 points. Another losing week for the Dow. I think it's 5 out of the last 6 weeks now. The S&P down 56, NASDAQ down 199. Stocks not reacting well to this news, today's news on jobs, today's news on this bank info. You got investors fleeing the market like crazy, money markets overflowing. Not great situation for stocks today. The bond market, however, the exact opposite. Sell stocks, buy bonds, flight to safety, everybody running for the hills. The 10-year dropping 23 basis points today, 3.69%. Wow. The 2-year falling 32 basis points, 4.58%. It was 2 days ago. 2 days ago it was 5.08. 50 basis points in 2 days. This is just, you don't see this in U.S. Treasuries, man. You just don't see this stuff. Market whipsawing around. This is going to be a way more common occurrence. I really shouldn't be acting surprised by this because it has been happening way, way, way more frequently than it historically does. But it would actually, I guess, depending on your point of view, rates were getting high, man. When you have a 10-year at 5 or a 2-year at 5, that's just going to make a big mess of everything. And a little bit of relief from those higher rates is good for consumers, I think, especially because most consumers haven't weaned themselves from debt yet or won't wean themselves from debt at all. So a little bit of relief is good, but wow, what a crazy day in these markets. The dollar, as a result of all this stuff, too, down, but just very small, 0.59 on the index, 104.63. So back down under 105, but still a strong number for the dollar. Metals today have a nice rally, though. Gold rallying $37.70 per ounce, $1,868. Silver up, where the heck is it here? Up 46 cents, $20.51. A nice little rally. I really believe metals want to run, man. I just, the market and everything's been fighting against it. I think there's money to rally gold and silver. It's just waiting for that opportunity, the right signal to do it. It's going to happen, believe it, man. Oil today up small, 81 cents per barrel. West Texas Intermediate, $76.53 per barrel. Right in the trough where we expect it to be. It's going to stay between 75 and 80 till it breaks out one way or the other. We've been keeping you guys well informed of this stuff. The Bitcoin today down $381, but the bad news for Bitcoin breaking below 20,000, 19,946. That's an important, round numbers are really important support and resistance numbers. I think Bitcoin needs to get back above that 20,000. We'll see what happens. News you guys need today. Well, a couple of big doings. First, we have the jobs report. 5:30 this morning, I'm bleary-eyed watching Bloomberg. 311,000 jobs last month. The estimate was for 225, and truthfully, they've been estimating high because jobs have been just hot, and boom, 311 jolts the market. Now, there was some good news in the report, even though the jobs numbers was way higher than they expected. Wages still rising, but rising slower than they have been. the unemployment rate actually rising with more people now participating in the job market, people coming back to the job market with jobs being plentiful and wages going up. So as a result, the unemployment rate actually jumps up from 3.4 to 3.6%. So kind of a mixed report, but certainly an indicator that the job market remains hot, wages still rising. This is what the Fed wants to know. So this then gives them the market then was pretty much now leaning toward, okay, we're going to have this 50 basis point rate increase, a half point bump next week when the Fed has their open market committee meeting. Then a couple of hours later, here comes the news. SVB, Silicon Valley Bank collapsing. The state and the FDIC coming and taking over that bank. It's the biggest bank failure since 2008. They had well over $600 billion. Was it $600 billion? Is a huge favorite. Silicon Valley, obviously, big techs, private equity groups, a lot of people having money parked at Silicon Valley Bank. Their undoing, believe it or not, was doing the right thing. They had all this money coming in. During the pandemic, tech companies boomed. They deposited lots of cash. Silicon Valley Bank took that cash and bought treasuries. But they made the mistake of going out longer, reaching for yield, right? And now with interest rates on the rise, if you have to sell those bonds, you're going to take a loss. Now, ordinarily that would be okay because you're just going to hold the bonds to maturity and you'll be made whole. But when word got out they were in trouble, depositors, a lot of the big companies started pulling funds out, forcing them to sell these bonds at a loss. Everything accelerates. It doesn't look like it's going to be a good thing. And their deposits were way higher than the FDIC limit is going to be for the amount of accounts they have there. So we'll see if the FDIC folds and comes to the rescue of all these rich people, or if they let them take the losses with a bank failure. That hasn't happened in quite a while in the United States, so it's going to be fascinating. We'll be on top of this, of course, for you guys as well. That is, now the question becomes, now we've had 2 bank failures in a week. We had Silvergate Capital, another small regional bank, basically the same situation, assets declining, a run on deposits, depositors wanting their money, selling into a weak market. Boom, they just surrendered and gave up. They didn't wait to be seized like as Silicon Valley Bank did. So now market all freaking out. Now looks like rates are going to go up, and then 2 hours later, here comes this news. Boom! Now the market's going, holy cow! Could this happen to Citibank? Could this happen to Bank of America? Well, yeah. Now they may have bigger reserves, but they have the same situation. See, guys, the way banks do their business is pretty simple, right? They borrow short and lend long, right? So you put money in a bank and you put money in your savings account. They take that money and pay you interest on it. Overnight rates, because you can pull the money out like it's still there in cash. They then take that money and lend it out long term, 30 years, mortgages, stuff like that. Usually the spread, when the yield curve is normal, they're borrowing money at 2 and lending it at 4, or whatever the spread is, and they're making the difference, right? But when you have a yield curve inversion, now it costs you 4 to borrow the money and you're only lending it 2. Well, how many loans do you think they're going to make that way? Right? I mean, why would you? It's an impossible situation. So now lenders raising standards. You're going to start seeing more and more people getting declined for loans. And here comes the big move for cutting credit card limits. And they're going to do everything they can do now to limit their risk for big runs on their reserves. It's just going to be a fascinating thing to see. And now you add on top of it this data where investors basically just had enough. stocks and bonds. Just, you're losing money no matter where you are right now. Some of the pros are making money, don't get me wrong, but the typical investor, guys like us, working people, the schmuckatellis, the people who aren't in this market every day watching it and trading, they're losing money. Doesn't matter how conservatively they thought their portfolio was invested. So now they're pulling money out of stocks, bonds, and everything and going to money markets, money market funds literally overflowing with cash. Pretty soon we'll start hearing about money markets having to close because they can't invest the amount of cash they're getting. I've seen this phenomenon before too. So we have all kind of fascinating stuff coming up now. So next week, we know the Fed's going to meet. So now what does the Fed do? Right? Are they going to raise a quarter, which kind of was the plan all along? Are they going to raise 50, half a point, because we know inflation's running hotter than it should be? Are they going to, the quarter probably would work better with the economy and banks having some difficulties. 50 tells us they're super aggressive at full speed ahead on stomping down inflation. They might even pause, depending on how bad the data they're getting on banks is. It's going to be amazing. It's going to be amazing, amazing, amazing. Real estate, still. Now with, we had our little surge, rates dribbling down to close to 6%. Market comes alive. People kicking tires. Let's take a look. Now rates charging right back above 7%. Snuffing. It was like killed in the crib, man. The little bit of a rally that came went just as fast as it showed up, right? And now you got two banks in the past week going under. Depositors possibly losing a lot of money, man, billions of dollars. It's just we have a lot to talk about. We're going to be following all of these stories and everything that comes along day to day for you guys. That's it for this week, guys. Go have a good weekend. Maybe don't peek at your 401k, statements this weekend. Forget about that for now. Enjoy your time off. Enjoy your weekend. Get a little sun on your face if you can, if you're not freezing out there. Enjoy your families, your friends. We'll be back to the crazy on Monday, won't we? And of course, we'll be back to give you guys all the news you need. Hold steady on your portfolios. The stuff we've been saying still goes. Save your pennies, as many as you can. Invest it very conservatively. Don't want to lose principal. Don't take on new debt. Pay down if you have any little bit of debt. You have to pay down, even if you're chipping away at it, $10 extra a month. A little bit extra. Just do the best you can, chip away at it. And it's okay to spend money. Just spend it thoughtfully. Spend it conservatively. Try to stay away from the impulses. The stuff that you kind of buy and now, 2 weeks later you already forgot about it. Be thoughtful. Get the things you need. But hold cash as much as you possibly can. You'll be glad you did, guys. Anyway, have a great weekend. We appreciate your support. See you guys on Monday. Until then, take care. Thanks.